Jobs report, U.S. labor market frozen in 2026. What this means next. The jobs report is out and it confirms something many Americans already feel every day. The U.S. labor market isn't booming, but it's not crashing either. It's frozen. Hiring is slowing. Layoffs are slowing. And momentum in both directions has stalled, leaving workers and businesses stuck in a strange economic limbo. In December, the economy added just 50,000 jobs, well below expectations. At the same time, unemployment fell to 4.4%. On the surface, that sounds fine, even encouraging. But when you look deeper, a very different story starts to emerge. Job growth is trending downward. Past numbers keep getting revised lower, and wage increases still aren't keeping up with inflation. This report matters far beyond the labor market itself. It directly affects what the Federal Reserve does next with interest rates. Just weeks from now, policymakers will decide whether to cut rates again or pause. And today's data may have just tipped the scales. So the big question isn't whether the labor market is strong or weak. It's whether it's strong enough to keep the Fed on hold, even as millions of Americans feel the pressure of higher prices, shrinking purchasing power, and growing uncertainty about what comes next. Let's watch. 1. The big picture, a labor market stuck in neutral. The latest jobs report confirms what many people already feel: the U.S. labor market is frozen. It's not collapsing, but it's also far from healthy or booming. Hiring is slowing, layoffs are slowing, and momentum in either direction is stalled. This kind of environment signals uncertainty rather than strength. In December, the economy added 50,000 jobs, which came in well below expectations of roughly 73,000. At the same time, the unemployment rate fell slightly to 4.4%. On paper, that looks acceptable. But when you step back, it shows a labor market that is losing energy, not gaining it. This is exactly why the Federal Reserve has been cutting interest rates, not because the economy is strong, but because it needs support. The labor market is no longer overheating, yet it hasn't broken down enough to trigger aggressive intervention. We're stuck in the middle. 2. Job growth is slowing and the trend is clear. When you look at the chart of monthly job gains over the past few years, one thing stands out: a clear downward trend. Job creation has been steadily weakening, month after month. December's 50,000 gain fits perfectly into that pattern. What's even more concerning is how often past numbers get revised downward. October was originally reported as a loss of 105,000 jobs, but it was later revised to a loss of 173,000 jobs, a massive miss. November's numbers were also revised lower by 8,000 jobs. These revisions raise serious questions about how accurate the current data really is. While December technically showed job growth, history suggests those numbers may not hold up in future revisions. That's why many people remain skeptical about the headline figures. 3. Unemployment and wages. The numbers versus reality. The official unemployment rate dropped from 4.6% to 4.4%, which the government presents as a positive development. However, these numbers don't always reflect economic reality. The unemployment rate excludes discouraged workers, underemployed workers, and people who have left the labor force entirely. Wage growth also jumped to 3.8%, up from 3.5% the previous month. On the surface, that sounds like good news. People are earning more money. But when you compare wage growth to inflation, estimated around 6%, the picture changes. Real wages are still falling. That means Americans are losing purchasing power, even as nominal wages rise. In practical terms, the middle class continues to shrink, and lower-income households feel increasing financial pressure. Higher pay doesn't help if prices rise faster. 4. Why the jobs report matters for the Federal Reserve. This jobs report plays a critical role in shaping Federal Reserve policy. The Fed's next meeting is scheduled for January 28th, and investors were watching closely to see if weak labor data would justify another rate cut. Before the report, there was a 13.8% chance the Fed would cut rates in January. After the report, those odds dropped sharply to 5%, according to the CME FedWatch tool. Why? Because the report wasn't bad enough. If job losses had surged or unemployment had spiked, the Fed would feel pressure to act. But because the labor market is merely weak, not collapsing, the Fed sees no urgent need to lower rates right now. In short, the report wasn't strong. 5. Looking ahead to March, same story, different month. The same reasoning carries over to the Federal Reserve's March 18th meeting. Before the December jobs report, there was a 59.1% chance that interest rates would remain unchanged. After the report, that probability climbed to 68.9%, reflecting the Fed's more cautious stance in response to stable but weak labor market data. The key takeaway is straightforward. As long as the labor market doesn't deteriorate sharply, the Fed sees little reason to act aggressively. Interest rate cuts are designed to prevent economic damage, not to boost growth when conditions are merely okay. 6. Layoffs are rising beneath the surface. While the monthly payroll numbers appear relatively stable, broader layoff data paints a far more concerning picture. According to the Challenger report, employers announced 1.2 million job cuts in 2025, representing a 58% increase compared to 2024. Warehousing experienced more than 95,000 job cuts, driven by supply chain restructuring, changing consumer behavior, and increased automation. The most alarming trend came from government employment. In 2025 alone, more than 308,000 government jobs were cut, a staggering 703% increase year over year. 7. Markets, liquidity, and what comes next. Financial markets reacted positively to the jobs report, but not dramatically. The S&P 500 rose less than 1%, yet still reached new record highs. This isn't because the labor market is strong, it's because liquidity is driving asset prices higher. The Federal Reserve is currently injecting roughly $40 billion per month into the financial system. That liquidity flows into financial assets, pushing markets higher regardless of economic fundamentals. This is why stocks continue rising even as job growth weakens. Conclusion: weak, not broken, and that's the problem. When you put all the pieces together, today's jobs report doesn't signal a booming economy, but it doesn't point to a collapse either. Instead, it confirms something more unsettling: a labor market that's stuck in place. Hiring is slowing, layoffs are rising beneath the surface, and wages aren't keeping up with the cost of living. For workers, that means pressure without relief. For the Federal Reserve, this report changes the equation. Because the data wasn't bad enough, rate cuts are now less likely in the near term. And that means borrowing costs could stay higher for longer, even as households continue to lose purchasing power. Markets may be hitting record highs, but those gains are being driven by liquidity, not by strength in the labor market. Let us know in the comments what you think about the jobs report. U.S. labor market frozen in 2026. What this means next. And don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.